Hi folks, welcome back to Murthy Finance Academy. Today we are going to discuss one interesting player from recycling sector, that is none other than Gravita India Limited. But before we proceed, a quick disclaimer: I'm not a SEBI registered analyst. Whatever the companies we are going to discuss are purely for educational purpose. So Gravita India Limited, which is a circular compounder kind of a company. So its Q3 fiscal year 2026 results show revenue at 1017 crores, EBITDA at 116 crores, and PAT climbing to 98 crores. So operations delivered record EBITDA margins of 11.4% via high margin value added product mix and enhanced domestic scrap sourcing. The real question: can Gravita scale into a lithium and steel without diluting its high velocity asset like 25% plus ROIC model? Is not, we need to watch out. So the Indian recycling sector is undergoing a violent transition from a fragmented, dirty niche into a sophisticated global industrial necessity. While generalist investors still view recycling as a localized scrap collection, the reality is a high tech game of global commodity arbitrage and logistics. The company has evolved into a multinational procurement powerhouse, leveraging a network across 34 plus countries to source feedstock where it is cheapest and process it where demand is highest. This isn't just a smelter, if it is a global supply chain play disguised as an environmental services firm. So the company, which incorporated in 1992 in Jaipur, the company has spent 33 years building an industrial moat across lead, aluminium, plastics, and rubber recycling. With 33 company-owned yards and a customer base exceeding 340 clients, the scale is now institutional. Unlike most mid-cap industrials, the fiscal discipline is proven by a 14-year history of uninterrupted dividend payouts. So the company's multi-layered moat, which is competitive advantage, is built on a procurement network of 1900 plus touch points, creating a raw material security that is nearly impossible for new entrants to replicate overnight. This is fortified by critical Indian import licenses and lengthy OEM approval cycles, technical vetting processes that acts as a silent barrier to entry. By focusing on customized value added products rather than dumb ingots, the company has transformed from a price taker into a specialized solution provider. So the core thesis is the metamorphosis of from a lead recycler to a diversified ESG conglomerate. So the math is mechanical. As capacity scales towards the 7 lakh plus metric tons per annum target by fiscal year 2028, the company is aggressively pushing its value-added product mix beyond 50%. The market consistently misses the asset-light nature of this growth. With 8 plus asset turns and 3-year payback policy on new projects, the company generates a pre-tax ROIC of 25% plus. This allows for massive capacity expansion fueled by internal accruals rather than dilutive equity or suffocating debt. So the company's Q3 fiscal year 2026 data highlights the distinct strategic roles within the portfolio. It's led EBITDA per metric ton of 23,035, which is up from 19,030 rupees in Q3 fiscal year 2025. So the primary cash cow funding for the group's expansion. Second, it's aluminum, where its EBITDA per metric ton is nearly standing at 14,215, down from 20,861. So the growth lever, though currently facing margin pressure as it scales new African capacities. Third is plastic, which is having a EBITDA per metric ton of 10,462, which is stable. So this is a margin optimizer providing a steady, lower volatility earning stream. So what is the company's expansion roadmap? So the path to fiscal year 2028, the company is currently in its most aggressive capex cycle, targeting 7 lakh plus metric ton per annum by 2028. However, the nature of the capital is changing. While existing lead and aluminum verticals benefit from high velocity 3-year payback and 8 plus asset turn model, the new ventures into lithium ion, steel, and paper will likely face higher capex intensity and longer gestation periods. A critical differentiation remains in the turnkey solutions vertical, where the company builds its own plants, drastically reducing the investment compared to peers buying off the shelf technology. So the company's financials reveals that revenue reached 1017 crores, a modest 2% year-on-year increase. But look deeper, 9-month volume growth was 5%, while PAT jumped 25% for the quarter. The delta proves that value-added mix and hedging are far more important than top-line revenue fluctuations. So coming to margins, EBITDA margins hit 11.41%, exceeding the historical 9 to 10% range. This is protected by back-to-back hedging mechanisms that locks in margins the moment scrap is purchased, neutralizing LME price swings. Coming to balance sheet, it is holding a AA minus credit rating. The company incurred 125 crores in capex during the 9 months fiscal year 2026. Pre-tax ROIC also reached 27% in fiscal year 2025, comfortably adding ahead of the 25% long-term target. Coming to its earnings trajectory, PAT grew 32% in 9 months fiscal 2026 to achieve the Vision 2029 goal of 35% plus profitability growth. The company must maintain this pace as it migrates into more complex, unproven recycling chemistries. So, coming to some con call highlights on Vision 2029, non-lead should be greater than 30%, which is a necessary pivot for the multiple, but can they replicate the same procurement dominance in the fragmented steel and paper markets is need to be watched out. On coming to its value-added products, which they are targeting 50% plus, this is the primary defense against commodity cycles, yet it requires OEMs maintain loyalty even as domestic collection costs rise. On domestic scrap sourcing, it reduces logistics and freight risk, but pits the company against a burgeoning unorganized sector that is increasingly competing for the same ESG compliant scrap. On ESG framework also, it is essential for institutional attracting, but investors must monitor if the 10% plus energy reduction target impacts short-term operating costs during the fiscal year 2027 capex spike. So if you see its valuation kind of a thing, the track record is undeniable. It's 5-year revenue CAGR of 23% and PAT CAGR of 57%. In a bear case scenario, if volume growth stalls at 10% due to African procurement export bans, multiple derates to a standard industrial smelter. In a base case scenario, if gets aligned with the Vision 2029 of 25% volume CAGR and 25% ROIC, stock maintains its current growth-led premium. In a bull case scenario, if value-added products exceed 60% and the lithium-ion vertical contributes to the bottom line early, re-rating the firm as a specialized technology recycler. So these are some scenario frames which I have given you for a basic understanding on the valuation. So some key risks are procurement concentration. Africa remains the heart of the feedstock engine with 98,000 plus metric tons of scrap. Any geopolitical disruption or shift in export regulations in these jurisdictions hits the supply chain mechanically. Second, lithium technology pivot. Rapid evolution in battery chemistry, example solid state, could render current hydrometallurgical recycling processes obsolete before the first plants achieve their 3-year payback. And third is hedging inefficiency. Extreme LME volatility or limit up days can create basis risk where the physical purchase price and the derived hedge diverge temporarily, crushing the margins. So, what is the final verdict if you ask me? The company is trading the volatility of a smelter for the consistency of a global circular economy leader. The bull case hinges on two metrics: the execution timeline for the first lithium plant and maintaining ROIC about 25% as capex spikes to a projected 346 crores in fiscal year 2027. If they succeed, the market will finally stop pricing them as a low multiple smelter and start valuating them as a technology-led recycling platform. Hope you like this video. If you do like this video, please do like, share, and subscribe to Murthy Finance Academy. Thank you.